Welcome to Trading to Rise. Have you ever just stared at an options price, watching it jump around and it just feels, well, totally random? Yeah, you're definitely not alone. But what if I told you that underneath all that chaos, there's actually a hidden blueprint, a set of rules that dictates every single move? Well, today, we're going to pull back the curtain and uncover that blueprint together. By the time we're done, you'll be able to look at any option and literally see the invisible forces that are making it tick.
So, when you pull up an option chain, that huge grid of strike prices and premiums, it can feel like the prices are just bouncing all over the place, right? Maybe the stock inches up, but your call option barely moves, or a price just looks way too high or maybe too low, and you can't figure out why. Well, here's the good news. It is not random. Not at all. There is a solid, logical blueprint behind every single price. And trust me, by the end of this explainer, you're gonna get it.
All right, so here's the game plan for today. First, we'll break down the 6 key drivers of an option's value. Then, we'll talk about the rules of the game, the price boundaries. After that, we'll reveal a secret formula that links puts and calls. We'll also tackle that classic trader's dilemma, when to exercise. And finally, we'll put it all together in your action plan.
Okay, let's jump right into our first section, the 6 drivers of value. We're going to get into the 6 key factors that are really pulling the strings behind an option's price. Okay, so this table right here, this is basically your cheat sheet. It lays out all 6 of the drivers we're going to talk about. A plus sign means as the factor goes up, so does the option price. A minus sign means the opposite. But look, just memorizing this isn't the goal. We need to get the why behind it. So let's dig into each one of these, one by one.
All right, let's start with the big two, the current stock price and the strike price. These two work in complete opposition to each other. Think about it. With a call option, you're betting the stock will go up and cross the strike price. So naturally, as the stock price climbs, your call becomes more valuable. But if that strike price is higher, it's like moving the finish line further away. It makes the call less valuable. Now for a put, it's the total opposite. You want the stock to go down, below the strike price. So a falling stock price is your best friend. And a higher strike price? Well, that gives you a better starting point for that drop, making your put worth more. This push and pull is really the heart of what makes calls and puts different.
Okay, next up is time. You can think of the time to expiration as the option's lifespan or its window of opportunity. I mean, if you buy an option that expires in a week, the stock only has a few days to make that big move you're hoping for. But if you've got an option with 3 months left, whoa, that's a lot more time for things to happen. More time equals more chances for the stock to move in your favor, and that's true for both calls and puts. So it makes sense that options with more time on the clock are generally worth more.
Now this one is super interesting, volatility. Let's call it the stock's energy level. If you just own the stock, high energy, high volatility can be pretty nerve-wracking. But for an option holder, oh, it's fantastic. Why? Well, think about it. Your maximum loss is capped. You can only lose what you paid. But your potential profit, it's huge. High volatility means a bigger chance of a massive price swing. And as an option holder, you love big swings. A giant move up is amazing for a call, and a huge drop is perfect for a put. That's exactly why higher volatility makes both calls and puts more valuable.
Okay, this next one is a little more subtle, and it's interest rates. Just think about the rate you could get on a super safe investment, like an Indian government bond. When these risk-free rates go up, it tweaks the math behind options pricing. For a call, you're basically paying now for the right to buy a stock in the future. Higher interest rates mean the future payment is cheaper in today's terms, which makes the call just a tiny bit more attractive. For puts, it's the other way around. Now look, this isn't a massive driver like stock price or volatility, but it's still an important piece of the puzzle.
And our final driver, dividends. The key thing to understand here is that dividends directly affect the stock price. When a company pays out a dividend, that's cash leaving the company. So, on what's called the ex-dividend date, the stock price is expected to drop by about the same amount as the dividend. Now, if you're holding a call option, that's bad news, right? The stock is dropping for a non-market reason. But if you're holding a put, that expected drop is actually good for you. That's why future dividends tend to make calls a little less valuable and puts a little more valuable.
All right, we've got the drivers down. So now let's move on to section 2, the rules of the game. See, an options price can't just be anything. There are hard limits, a ceiling and a floor that keep everything logical. These are the fundamental boundaries. So let's talk about the price ceiling. This is all about pure, simple logic. A call option gives you the right to buy a stock. So, would you ever pay more for the right to buy something than for the actual thing itself? Of course not. That would be crazy. That's why a call option can never, ever be worth more than the stock itself. And for a put, it's similar. A put gives you the right to sell a stock at the strike price. The absolute best you can do is if the stock goes to zero. In that case, you get the strike price, so a put can never be worth more than its strike price. These are the hard ceilings that keep the market sane.
Okay, what about the price floor? Now, this gets a little more technical, but the idea is actually pretty simple. An option has to be worth something if there's a chance it can make money. For a call, for instance, its value must be at least the stock price minus the present value of the strike price. Why? Because if it were any cheaper, traders would jump on a risk-free profit, what we call arbitrage, and the market just doesn't let those free money opportunities stick around for long. So these lower bounds act as a safety net for an option's price.
All right, get ready for one of the coolest and most powerful ideas in all of options. We're on to our next section, the secret formula. What if I told you there's a hidden mathematical connection that links the price of a put and a call? Well, there is. So the big question is there a direct mathematical relationship between a put and a call? And the answer is a resounding yes, absolutely. You can think of a put and a call with the same strike and the same expiration date as two sides of the same coin. They aren't independent. They are deeply mathematically connected. And understanding this connection, it's like having a secret decoder for the options market.
And the logic behind this is actually really elegant. Check this out. Imagine you create two totally different portfolios. Portfolio A has a call option and some cash. Portfolio C has a put option and a share of the stock. Now, here's the magic. No matter where the stock price ends up on expiration day, both of these portfolios will be worth the exact same amount. And if two things are guaranteed to have the same value in the future, well, they have to have the same value today. It's that simple.
And this is the formula that comes out of that logic. Now, don't get hung up on the math here. You don't need to memorize this. The big idea is what matters. Puts and calls are forever tied together. One can't get way out of line without the other. This formula is basically the market's built-in balancing act. It's a self-correcting mechanism that keeps everything rational.
Okay, let's get super practical with this next section. It's the trader's dilemma. You've got a winning option. It's in the money. So what do? Do you exercise it early or do you sell it? Let's break down the early exercise question.
So options basically come in two flavors. The first style lets you exercise any time you want before expiration. The second style is more common for index options here in India. You can only exercise it on the final day. So when you have the choice, when is it a good idea to exercise early?
All right, here are the simple rules of thumb. For a call option, it is almost never a good idea to exercise early. Why? Because when you sell an option, you get paid for its remaining time value. When you exercise it, you're literally just throwing that time value away. You're almost always better off selling it. Now, for puts, it's a little different. It can make sense to exercise early, but only if it's super deep in the money and you want to get your hands on that cash right away. But honestly, for the vast majority of trades, the answer is the same. Sell the option. Don't exercise it early.
Okay, we have covered a ton of ground, haven't we? From the 6 drivers to the rules of the game and that early exercise question. But theory is one thing. Applying it is what really matters. So in this final section, let's boil it all down into your action plan.
So here are the 4 key takeaways you can start using immediately. 1. Master those 6 drivers. Before you place a trade, always ask yourself, what happens if volatility changes? 2. Respect the boundaries. Know the price limit so you don't overpay. 3. Use put-call parity as a mental check. Make sure things look rational. And 4. Know when to exercise, which is almost never for calls. You're better off selling. Seriously, if you bake these 4 ideas into your process, it will fundamentally change how you approach your trades.
So as we wrap this up, I really want you to think about this. How are you going to use this blueprint on your very next trade? This isn't just theory, it's a real-world framework. The next time you're looking at an option chain, how will you use these concepts to make a smarter, more confident decision?
Here's your mission. Apply these lessons in your next trading session. And make sure to subscribe to the Trading to Rise channel so you don't miss the next episode in this series. Thanks for joining me.